In my previous videos, there have been some phrases that I have referenced repeatedly, two of them actually, and those two are gross income and the word taxable. When I say taxable, I'm really referring to taxable income. So I've been using the two phrases gross income and taxable income quite a bit, and both of these definitions are vital concepts when it comes to tax. So I just want to explain what exactly this means. Now, in part 1 of the series, I defined gross income. And gross income is all income from whatever source derived except as otherwise provided. Now, taxable income refers to the amount of income that you made in a given year that the IRS deems that it can tax. Even though the phrase taxable income has the word income in it, there is a difference between taxable income and just income. Income is just any increase in wealth, but income can include non-taxable income. Non-taxable income is the portion of income you make that the IRS says is not taxable. So let's see an example. Let's say that your income is 100K. However, you determine that out of the 100K, 10K is not taxable. What that means is that even though your income is 100K, your taxable income is only 90K, right? 100K minus the non-taxable portion of 10K. That means that only 90K of your 100K income will be taxed. The other 10K is tax-free. You will not be taxed on that at all. Only the 90K, the IRS says, is what they will tax you. That 90K refers to taxable income. So taxable income is a portion of your income that the IRS says is taxable. Now, what about gross income? Well, gross income is a part of taxable income. To figure out your taxable income, you first need to know what your gross income is. Now, unlike just income, all of your gross income is taxable. So if your gross income is 100K, that means by default that all 100K of your gross income is taxable, because that's what gross income is. It's referring to income, right? That is taxable. However, gross income and taxable income are not synonymous either, right? That's why this video exists. That is because although 100% of your gross income is included in taxable income, in order to arrive at your taxable income, there are certain adjustments you can make to your gross income, and this is called your adjusted gross income. Now, from your adjusted gross income, you can take what's called either a standard or an itemized deduction to reduce your taxable income. We'll talk about this more in future videos. But know that because all of your gross income needs to be calculated first in order to arrive at taxable income, and then from there you can take measures to reduce your gross income, such as what I just said, making those adjustments, taking the standard or itemized deduction. Because of that, your gross income will never be smaller than your taxable income. Actually, in fact, your gross income will always be higher than your taxable income. And that is, of course, because when you try to calculate your taxable income starting from gross income, again, you take measures to reduce that initial gross income figure. So, just as a recap, if something is included in your gross income, that means it will be taxable. However, once you have calculated your gross income, you can take certain measures such as adjustments and the standard or itemized deduction, and this will get you your taxable income amount. And that is the portion of your income that you need to pay tax on. So I hope this video has helped clarify the difference between gross income and taxable income.